Hey everyone, this is John Robinson. I'm the CEO and co-founder of Blueprint. Today is September 30th, 2021, and this is the monthly asset allocation update video. As you might imagine, there's a lot to go over today, and since my marketing team has given me about a 10-minute cap for these videos, let's go ahead and get started. However, I would encourage you to go back and read the longer form note, as what we don't get to in detail on the video, you will find in the note, and find a lot more detail and some data around what we talk about in the allocation shifts that we review in this video. So with that said, US equities, we will, despite the near-term volatility, actually increase allocations to US equities, not because of a trend change, but because of weakness in foreign markets. US large caps remain and have been for some time the largest equity segment, whether domestically or globally, and they remain so. So they will increase in their allocation, and that is from foreign stocks. Emerging market stocks remain in an intermediate term downtrend, very close to a long-term downtrend, but not quite there. We've reduced exposure there a few months ago, and that exposure remains underweight. And we're now underweight foreign developed stocks. There's an intermediate term downtrend there. The long-term trend remains intact, but all that exposure that was pulled from emerging and now pulled from foreign developed is being pushed up to US. So total equity exposure will come down a little bit, but now the mix has changed from about 50-50 US and foreign to about 80-20 US and foreign. So it's now very domestic US stock overweight versus foreign and emerging. Real estate is unchanged. Real estate remains strong, probably the strongest asset class we have in the portfolio over intermediate and longer term samples. September, it was one of the weaker asset classes, but longer term, it remains exceptionally strong. Fixed income, you've probably noticed the 10-year rate rising for the last 45 days or so, almost back to its near-term high that was established in March of this year. The intermediate term bond has weakened, is in downtrends over both time frames, and that exposure will be pulled off and handed to ultra short-term duration cash equivalent type exposure, as well as TIPS. Despite all of the inflation talk, TIPS are now in an intermediate term downtrend. The long-term trend remains intact, but you're seeing this very interesting bifurcation in inflationary type assets, where commodity assets are increasing, particularly soft commodities, cotton, sugar, soybeans, and corn, but the paper tied to that, like TIPS, is not. And in fact, we're reducing exposure to TIPS going into October, and just like intermediate term nominal bonds, pushing that exposure to ultra short term cash equivalent bonds. And short term fixed income is increasing due to lowering duration, but all that exposure will then float to bonds with 30 to 60 day duration. Alts remain unchanged. This is still expressed by gold, and gold remains in downtrends over both time frames we follow. So when you look at the graph here, the graph really is US exposure will increase, and that's from foreign stocks, as well as ultra short-term duration fixed income will increase, and that comes from both inflation-protected bonds as well as foreign bonds. So what are the big picture takeaways as we approach October? We're entering the fourth quarter. The fourth quarter is historically can be a very interesting time for markets statistically. We're seeing volatility increasing, and that's causing prices globally to fall, some more than others and at different rates of change. But on the whole, US large caps remain the strongest equity segment. Allocations going into October are really experiencing a flight to quality. In our single stock models, which is what drives our fund exposure and therefore a lot of our managed account exposure, we're seeing a movement towards more mega cap tech, consumer discretionary, and then some value segments like financials. Some of the interest rate moves have benefited some financial stocks, and you've seen strength there. And therefore, we're pulling exposure from the weaker names and then just pushing it up to and overweighting some of the larger and mega cap names. Lastly, and you'll notice this in the note, it is the feedback we hear and how we run our business is that these periods in particular give you an incredible opportunity to create certainty for clients with your process. Now that process can be written down, it can be codified, it can be automated, but it needs to be rules-based. And a process can't be developed in the midst of, or can be, but maybe shouldn't be developed in the midst of volatility. Volatility typically in markets, a symptom of that is fear. And we as humans can make interesting decisions when fear is high. And you see that in the Dalbar studies, and you see that in everything we talk about and write about. And while the future might be unknowable and is unknowable, your reaction to the future shouldn't be. And the opportunity is to review the process, the rules-based process with clients, proactively communicate with them in the moment, in real time, be able to communicate with them and say, look, markets are doing X and our predetermined rules-based process is doing Y. And should these conditions change, here's how we'll react. And that certainty reduces fear. And it's not certainty about the outcome, it's certainty about the process. And that's the key, and that's probably the most important thing. So if you want to discuss that with us, you want to discuss our process, you want to discuss our process in the context of your business, we'd love to have that conversation with you. Also, I would just ask, what can we do for you? Could we have a conversation with you and your clients, you and your team? As volatility picks up, the volume of things that we're doing with clients or with our clients, which are advisors, on for the benefit of their clients grows. So we're doing a lot more calls, we're doing a lot more content, a lot of white labeled content, in fact, for advisors, even describing what our process is and how it relates to the current environment. So nothing's off the table. I'd encourage you to ask us, have that conversation with us. So with that, I hope it's a great month. I hope it's a great start to the quarter for you and your clients and your families. And I look forward to being with you again at the end of October. Thanks.